was down, I think, 11% from the highs. We were in very much oversold territory, and then of course, the Maharashtra elections came through as well for the BJP. So that was a kind of catalyst to get the market to kind of, I would say, kind of just move up from the lows, which we've seen, and it's been as you said, a powerful kind of rally. Aided, I think, also by global factors. But what I would say is this, is that, there's no catalyst at the moment for the markets to keep moving higher because, earnings are under pressure. We saw a big downgrade by the RBI in terms of the GDP forecast. And that's even higher than most consensus in the market. The market consensus for GDP for this year is running between 6 to 6.3%. So there's still a lot of slowdown that could possibly happen between now and the end of the year. So I'm a little bit skeptical that earnings are going to pick up. And if anything, more downgrades could come. So, it's a nice Santa Claus rally, enjoy, but I'm not sure I would be buying into it at this point.
Andrew, also, you were talking about how the Reserve Bank of India sort of surprised the market. I think considering the GDP numbers, some of us were expecting that we may see a rate cut, especially with at the time when US Federal Reserve has been reducing rates. They have reduced rates by about 75 basis points. But what they have done, what RBI and Shaktikanta Das have done is reduce the CRR or cash reserve ratio limit by about 50 basis points, which will inject by about 1.16 lakh crore liquidity into the system. Do you think that will help bring back consumption at a time when we are just entering the festive season, the wedding season? Or do you think that more needed to be done as far as the policy was concerned?
No, I mean, it does help at the margin, and obviously it gives you an indication that the RBI is looking towards moving interest rates lower going forward. I think it's a difficult decision. I mean, I agree. I think they should have gone with 25 basis points to front end the slowdown that we're seeing in the economy. But again, that said, they can now see what the Federal Reserve does next week, and they can also see, initially, what Trump policies might be when he takes over in kind of late January. So gives them that kind of comfort level in terms of seeing what's happening around the world, not just withstanding what's happening in India. So I'm okay with that. What I would say is that in a slowing economy, you got to find companies and people to want to borrow, right? So if it's a slowdown, there might be a slowdown in consumption as well. As corporate borrowing. So I'm not, liquidity always helps at the margin in terms of the interest rates you're paying, but not really. I think a rate cut has to be there. So I think the longer we leave it, the more I get worried about it.
Andrew, the markets have opened and we are seeing a bit of a cautious start to trading this morning. Nifty is down by about 0.2%. It is still holding above that 24,600 mark. The broader markets, they also seem to be mixed. The small cap index, by the way, continues to do well. It's up by about 0.15%. Some bit of correction in the mid cap. It's trading flattish with a negative sort of a bias. Although India VIX, that has been holding steady below the 15 levels, which is, I think, good to see. But across the board, we are seeing selling in sectors. Nifty Bank is down 0.25%. The auto stocks, they are trading on a flattish note. FMCG pack overall is down 0.5% or so. And, the IT stocks also are trading with a weaker bias. I mean, for the investors out there, what do you think is a good investment strategy and how should they approach the markets at a time when the global cues, they are indicating a lot of uncertainty? We have seen good recovery from the bottom. How should investors approach the market at this point in time, sir?
So I think, it's a two-pronged approach is what I would take at the moment. I think those who are sitting on or have liquidity at the moment, I think a strategy of just sitting on that cash. I mean, you can put it in fixed deposits or other, higher interest bearing instruments, just for the next month or so. And I'll tell you for why. I mean, I've gone through what I think is going to happen in December, which is, probably more of a positive kind of ending to the markets. But come January, that volatility starts to pick up. And, whilst there's lots of narrative about what President-elect Trump will do, he's unpredictable as well. So I'm not sure I want to kind of be ahead of what I think he's going to do or what the market might be telling me he's going to do. So I think I could just wait see what some of those policies are, see if it's going to have an impact on global trade, how would that impact India. All of those things will come out in the next 1 month or so. So, even if, it's more positive for global, global economy and for India thereafter, missing a few percent of the market rise in the longer term kind of rise in the markets, I'm okay with. So I think a strategy of just being cautious, sit on the sidelines with a bit of cash. Anyway, the valuations in India don't compel you to kind of think that it's going to be a great return in 2025-26. Earnings are being downgraded. So at best, you're probably looking at single-digit returns next year. I mean, high single-digit returns next year. So I think the expectations need to be pared down as well. And I think the trading range between now and January the 20th is probably between 23 and 25,000 on Nifty, with probably the bias towards the downside as we go into January.
But waiting on the sidelines hasn't really worked out for the investors. I mean, considering the strong 6% sort of a recovery that we have seen, I mean, considering like investors, of course, global cues that are coming out are quite indicating a negative sort of a bias also, and we have a lot to look forward to as far as what the policies of Donald Trump are going to look like. But if someone has a cash, what is the ideal strategy on how to, perhaps make a play on the market? Should they stick to, perhaps the SIP route, keep investing over there, look at perhaps passive investment modes like ETF, or maybe stock-specific approach could work out, considering that we have seen very good recovery in the broader markets, mid-cap and small caps. What a tremendous run they have been. Both indices are up about 9 to 11%. 11-day winning streak they are on. 95% of the market, as we know, is small and mid-cap. So what do you think is the right move for investors?
I think just in case of what you've said, I mean, I know you said there's been a sharp recovery, but if I look at some of the small and mid caps, I mean, some of them are down significantly. So there's been some pain there for the retail investor. If you just look beyond the kind of broad indices, because that's not really the story of some of the retail investors, or a large majority of the retail investors that I come across as well. So there has been some pain there. But you're right. I think 2 points. One is stick with your SIPs. I completely agree with that. You buy at the top, you buy at the bottom, and you buy in the middle. And I think over a long period, you'll make a very, very strong equity return. So SIPs is really the way to continue going. I think, obviously, if you've got a portfolio of your own stocks, you would know them. The retail investor would know which stocks they like. But I think, look at what you think is going to be the themes going into 2025. What are they going to be? Which of the sectors are going to be the beneficiaries? And then you can identify those companies, which you believe will be, the leader or the beneficiary of that sector moving higher. For example, we talked about this before, but the hospitality industry, people wanting more and more experiences. So the hotel sector, airlines, that's a longer term trend that's not going to go away from you. So those kind of sectors, I think, will continue to do well, and the companies, the leaders in those sectors, will continue to take advantage of the continued spending and experiences that more and more Indian people want to enjoy now.
All right, Andrew, before we let you go, also wanted to get your view on one particular sector, FMCG. I mean, that has been a major drag on the market. Earlier, it was that rural consumption was pretty much being a spoil sport. We were not seeing much green shoots of recovery over there. But something interesting happened in the GDP numbers. Agricultural output actually increased and, increased by about 3.5% at a time when overall growth was much slower. So there are signs that rural economy is recovering. But at the same time, the recommendations that have come from the GST Council, I think they are going to introduce a new tax slab, 35% tax rates on, tobacco, cigarettes, as well as aerated drinks, which could really impact some of these stocks out there like ITC, Godfrey Phillips, even Varun Beverages comes to mind. What is your overall view on the FMCG pack, sir?
Yeah, it's going to be a tough time. I saw there's a profit warning out by brokers on Godrej Consumer as well. following an analyst meet or whatever they've recently done. So there's still a lot of pressure on margins, and I think the problem for not just the FMCG sector, but overall for India Inc. is that your top line's falling, but your margins are really under pressure. And that's what's been leading to downgrade. So I think for FMCG, it's going to be a constant struggle this year. I don't think the rural economy is picking up as quickly as they would hope to take over the consumption slowdown as well. So the way I still like to play this FMCG is more through premiumization. And again, I think premiumization in the alcohol and non-alcoholic industry is something which I think will continue over the next 3 to 5 years minimum, and I think that's the way I would like to play it as younger people, will move up the curve a lot quicker, than maybe people before that, in terms of just wanting to try, an experiment with higher premium drinks.
All right, that's Andrew Holland, CEO of Avendus Capital for you, sir. Thank you for giving us time here on News, and always great insights from you.
Thank you, and thank you for the opportunity. It's always my pleasure.